All accounting transactions must be recorded in the accounting information system. To understand the nature of recording transactions, it's best to start with the fundamental accounting equation, and you can see that in the middle of this slide. That equation is assets are equal to liabilities plus equity. The equation states that a company's assets must always equal the sum of its liabilities and equity. This means that any change to the equation must be accompanied by a second change to keep that equation in balance. And so, thinking about what we already know about financial statements, this explains why our balance sheet has to balance because of this basic accounting equation. And you'll be amazed by how many times we're going to come back to this notion. So it's very simple but very powerful. Every accounting transaction must affect at least two accounts. This requirement is known as the dual nature of accounting. So not dual, but two. If a transaction increases an asset account, for the accounting equation to stay in balance, the transaction must either decrease another asset account or increase a liability or equity account. So let's look at a few examples of how accounting transactions affect the accounting equation. So in transaction number 1, with this, we're going to use a fictitious firm called Circle Films. So in this transaction, Circle Films receives cash of $15,000, and therefore assets are increasing because cash is an asset. Its equity is also increasing, the firm's equity that is, because investors have contributed cash for an ownership interest in the company. So more specifically, Circle Films common stock is increasing. Let's take a look at transaction 2. In this transaction, Circle Films is exchanging one asset, cash, for other assets, equipment and supplies. They're buying stuff. Therefore, assets are both increasing and decreasing by $10,000. The net effect is no change in total assets. Let's look at transaction number 3. In this transaction, Circle Films is receiving cash as a payment, and therefore assets are increasing. Again, cash is an asset. But unlike the last transaction where assets were exchanged, the increase in assets in this transaction is coming from filming that wedding. So this inflow of assets is from providing a service, and so that service is revenue. Revenues increase net income, which is not on the balance sheet, it's on the income statement, but that in turn increases retained earnings because that's how the income statement and the balance sheet are linked together. So as a result, Circle Films retained earnings, and therefore its equity is increasing along with cash. In transaction number 4, Circle Films is getting money again. So they're getting cash from a customer, which means again assets are increasing, but this time it's a deposit. So that means Circle Films hasn't provided the service yet. So this is actually a liability. They've received $2,000 and now they have an obligation to either give that $2,000 back or provide the service. So as a result, Circle Films liabilities are going to increase this time for that same amount that their assets increase, the $2,000. In transaction 5, because Circle Films is actually paying out cash, it sounded like outcast. Because they're paying cash to run an ad, their assets are decreasing. This decrease in assets results from advertising expense, and so a decrease in assets from operating a business is an expense. Expenses decrease net income, remember again over there on the income statement, and so that in turn decreases retained earnings. So as a result, Circle Films' retained earnings and therefore its equity is decreasing as a result of this transaction. In transaction number 6, Circle Films receives no cash at the time of the competition that they filmed. And so as a result, Circle Films now has a receivable from the customer. The customer owes Circle Films $3,500. Therefore, Circle Films assets are increasing because accounts receivable is an asset. And since the receivable is generated by providing a service, Circle Films has additional revenues and therefore more equity. So equity is increasing as well as assets. So note that this transaction is very similar to transaction number 3, where they received payment right after the wedding, but the only difference is the type of asset that's increasing. So instead of receiving money and cash increasing, they invoice the customer, so accounts receivable was increasing. But both cash and accounts receivable are assets, and on the other side, in both transactions, number 3 and now number 6, retained earnings was increasing because this was revenue. In transaction number 7, interest is charged at a 6% annual rate because they took out this promissory note to buy the video camera. So this one is a little bit like transaction number 2. In transaction number 2, remember, they bought a video camera and memory cards, but they paid cash. This time, they're using debt, let's say. So in transaction number 2, they're receiving the equipment, so assets are increasing. But unlike transaction number 2, they're promising to pay the cash plus interest in 2 years instead of paying the cash at the time of the transaction. So in this case, liabilities are increasing instead of having the assets decrease by the same amount as the purchase. In transaction number 8, Circle Films is exchanging one asset from another. So in this case, they're getting cash and they're closing out that invoice. So they receive cash in satisfaction of the receivable that was created when that service was performed. So as a result, cash is increasing while receivables are decreasing. In transaction number 9, Circle Films cash is decreasing by $2,000 because they're paying out that much in wages, so their assets are decreasing. Remember, cash is an asset. Since the payments are an outflow of assets from operating the business, the payments are an expense, which is a reduction to equity. So therefore, equity is decreasing while cash is decreasing. In transaction number 10, cash and therefore assets are decreasing because they're paying out that owner's dividend. Payments to a company's owners are called dividends, and remember we talked about that in chapter 1, and so dividends decrease equity, so that means both assets and equity are decreasing.